First agenda item today is pension board progress to date. Dave, you
Sure.
I believe are going to lead the charge.
Yeah, happy to. And I'd just like to echo the greetings. And just to echo a little bit, I mean, what brings us here are a couple of different threads. Right, we have our history of in the summer meeting really focusing on a topical issue. And over the last 3, 4, 5 years, we've focused on our faith and finance initiatives and ESG in particular. So this is part of our regular routine where we take a little bit of a breather in the summer from our hectic pace and decision making to be a little bit more generative and step back and think about our direction. And that's really where you trustees can come in. To set the tone, to set the compass, you know, in which direction, and we know where to head. Secondly, current events. I mean, we talked about climate change. We also talked about the regulatory backdrop and the scrutiny over ESG, which will be a plank that we will address. And then further, I've alluded to it, but it's really our unique place as the United Church of Christ managing a pension. And other clients' money in terms of our mission and our desire to align our investments with who we are, and you'll hear more about that. But enough, you know, from me. Any of you who know me knows I like to control the narrative, but I'm actually going to take a little bit of a step back today because I'm here along with you. My staff is here with you to learn from a number of our experts in 4 different threads, and we'll start off again with Carolyn and GSAM leading a section, as you saw on your agenda, on where we've been. We'll take about an hour to do that with ample time for questions. We will then move to a panel for about 45 minutes with 3 experts from different perspectives to help inform our path forward. We will then hear from an author well-versed in climate change and implications. And then another real treat will be that we hear from two of our most recent investments in the area of climate mitigation and climate change. So I hope you enjoy it. I certainly plan to. Please put your questioning hat on and continue the dialogue that we had yesterday. And with that, I will just shut up and turn it over to Carolyn. Carolyn, why don't you take it from here? And Daisy, you can move to the slides and let's get going.
Thanks so much, Dave. And thanks. Good to see everyone. And it certainly has been and continues to be a journey. And so I think maybe that can be the theme for the session, which is that this is a long-standing trend with PBUCC in the industry, but at the same time, there's still plenty more to come, and a fast-moving space. So with that, we pulled together a couple materials, and I'll walk us through. First, a bit of an introduction to ESG and impact investing. I know we have lots of informed participants on the call today that are familiar with a lot of these topics, but I think it is helpful to level set, remind ourselves of terminology, and a bit of the why. And then we'll turn to more specifically for PBUCC, your own faith and finance journey, and we'll share where we are and what we've done. So with that, flipping to the first section, page 5, if I refer to numbers correctly. Excellent, thank you, Daisy. So what is ESG and impact investing? So first, ESG, environmental, social, and governance. And when we think about it, really we're talking about several different types of investing as we've laid out here. It's really a spectrum or a continuum. And I'll just go through them. So alignment, by this we mean excluding certain things in our portfolio or tilting towards certain things. It's often more of a values alignment. So based on our values, morals, our mission, as opposed to purely an investment-driven thesis, although there sometimes can be an overlap there. But the idea there is saying, if I'm going to invest in something, let me make sure it's aligned with my mission, and typically that means screening out things that are antithetical to my mission. And so examples of what we do for PBUCC are screening out where we're able to in separately managed account, things like firearms, tobacco, gambling, thermal coal, as well as the Northern Trust Global Sustainability Index Fund. But the second part, so that can be done in passive and active, those screens. The second part, ESG integration, is really about active management. So saying, how do these factors influence the particular stocks or bonds that I'm going to buy? And let me integrate those factors in the decision-making process. So it is an active approach. It doesn't necessarily mean that it's the primary factor that a manager focuses on, but it is at least a factor, one of the factors. And so we have the degree to which managers focus on that can vary, and we have a number of managers on the platform in the sustainability and the Sustainable Balance Fund that are deeply focused on this, and they do consider it a primary factor. I'll get more. I'll touch on that a little bit more. How we think about all of your managers on that ESG rating, that ESG integration a little bit later. But the next type of investing is what we call impact investing. So that's where we invest money, we want to tie it to a direct, tangible benefit, a direct, tangible impact, and this is usually in the private space. And so those are sort of the three broad ways that we think about ESG and impact investing. And I think as we were collaborating with and preparing with Dave and Lon and Minotti and team, we wanted to make sure we emphasized this fourth big column of engagement. We've always thought of engagement as a piece of the puzzle, but we wanted to make sure we were showing that it is an equal part of this investing spectrum. And under engagement, you'll see two types. One is corporate engagement, so direct conversations with companies, usually companies in which we're investing, usually equity companies where we have a vote, and engaging with them. And there have been a number of examples. There's an example there in terms of the FedEx conversation about what their commitment to net zero is. But then there's also more broadly collaboration with industry groups, whether it's UNPRI, so the PBUCC signed up and became a signatory of that, whether it's other faith-based organizations or other asset management organizations. There are lots of organizations out there which collectively can just harness the broad, serve to harness the collective assets and the collective voice to make progress on some of these issues. So that's the different ways in which we might think about and incorporate this in our portfolio and across the platform. To then flip to the next page, just a quick reminder, when we say in ESG, environmental, social, and governance, that is still a big header, and there are lots of things underneath that. And you can see them here. It's not just about climate change under environment, but it's also about water use, pollution, social issues, could be human rights, workplace benefits, diversity is sometimes considered under the social aspect. And then governance, a lot of, you can see here, political contributions, executive compensation, business ethics, et cetera. The one message I want to flag on this page is that a lot of these items are things that have been taken into consideration for years and years. So if we're investing in a company, we want to make sure there's no fraud at that company. We want to make sure that they have good business ethics, that we know what they're doing, that they're treating their people well. And so that's what one of the ways in which I meant that some of this has been going on for many, many years. That if you ask a lot of active managers or managers in general, they would say, well, yes, I've been doing some of this for years and years. Although I think what's different is that previously it was perhaps more focused on the governance, maybe a little bit in the social issues, versus now we're considering the full spectrum of environmental, social, and governance issues. And if we flip to the next page, then it becomes a question of why. Why are we doing this? Why is the industry focusing on this? Why are managers focusing on this? And what's really shifted in the past few years is that it went from being a morals or values-based conversation to being a more central investment-based conversation. And a greater recognition that if we are trying to invest for the long term, for the many decades in the future, there are factors that will influence those things, like the long-term sustainability. But broadly, we think of three main reasons why this has really come into focus in the past couple of years. The first is changing preferences. So consumers now more focused on the sustainability of the things they do. You know, they're voting with their wallets, as well as companies. More and more companies now committing to things like net zero targets. So it's just more consumers, workers, companies are, as well as regulators are focused on this and placing a priority on it. The second is growing consequences. So this is from a risk perspective. You know, the number of once in 100-year floods, once in 100-year hurricanes, droughts, fires, you have it, as we all know, no longer happen once every 100 years. They happen every 20, 10, 5 years. And that has a real financial cost. And so that financial cost is recognized, and hence stakeholders are asking what to do about it. And then the third side is improving economics, and focusing on the environmental side. Again, you know, the cost of renewables have come down dramatically, such that it is much more cost effective, and depending on which specific renewable you're talking about, just as inexpensive, if not even more so inexpensive than traditional fossil fuels. And so it's making it a real viable economic choice as well. So that's the why, and how that translates into specific themes is on the right. And we think of, under the broad sustainability, as two interrelated themes: climate transition and inclusive growth. So climate transition, how do we transition our economy, governments, the way we work and live, to mitigate our impact on the climate and the world? And then inclusive growth, how do we increase growth for everyone by increasing access and increasing affordability to more people? If we increase access and affordability to more people, we can get more growth for everyone. So those are the two themes, and the why this has really taken off and grown in years. And then the final page in here, page 8, just gives you some more data and factoids to point to how much bigger this is and how much bigger it's become in recent years. So on the left-hand side, you can see this is organizations that have signed up for PRIs, that's the UN Principles of Responsible Investing. So you can see over 100 trillion in assets have committed to UNPRI, over 3,000 signatories. And on the right-hand side, this is showing fund flows into ESG versus all or non-ESG strategies. And so you can see the ESG strategies have seen strong inflows. So it's not just people committing to these things, but investors are actually moving money into ESG strategies and funds. And so it is happening. So I'll pause there on that background and overview. Any questions on that? Okay, great. So turning more to PBUCC and what we're doing. If we turn to page 10, it is a core concept and principle of PBUCC's identity. And you know, we're repeating back to you what we see. And I think Eleanor and Shruti, we even found this on your website, right? So it is there for everyone to see and find what your focus on faith and finance is, what your mission statement is, and the vision. And so it's very clear that you're about providing financial security, providing sustainable investment, and it's in your DNA, and that's great that it's a very clear guiding principle. And how that's actually been implemented, if we turn to the next page, page 11, has varied over the years, or I won't say varied, has you've done a lot over the years in light of that and in recognition of that mission. So going back to 2014, you know, the initial revision of your socially responsible and guidelines, all the way through to rebranding your balanced fund to a sustainable balanced fund, and then to today and having these symposiums, which is now, you know, a couple years running, where you take the time to step back and focus on it. The one other thing we wanted to flag, which is on the top of this page, is while that's the prior page had your overall mission and values, how that's been identified or translated is into 3 particular areas of focus. One is resources, renewables, and climate change. The second is healthcare and healthcare accessibility. And the third is education, human capital, and development. And I think what's really nice is those 3 themes map well to the 2 themes that we had talked about, climate change and inclusive growth. And that's really helpful for all of us when we're actually trying to make investment decisions, to have those more specific themes in mind. How does this further or benefit those themes? So it's great that that's been crystallized. So that what we then do in the next couple of pages is we have a couple of slides that show in a little bit more detail some of the specific things we've done. So here we're talking about alignment. We, as I mentioned, have a number of exclusionary screens, and so Rick has really been instrumental and key in this, and identifying what are some of the screens that we want. And on the left, you can see we have these screens on firearms, gambling, tobacco, and then thermal coal and tar sands. We apply those wherever we have separately managed accounts, so where we're able to. What's nice about the materiality threshold is I think it reflects the sophistication of the approach, that there can sometimes be data issues. And so we want to make sure we're not screening out somebody that maybe has 0.01% revenue from something because they sold one thing once, but where it's a real part of the business. And then the second key part of our ESG alignment is with our Northern Trust Global Sustainability Index Fund. And what this strategy does is it takes an index that's published by MSCI called the MSCI ESG Leaders Index, and it manages to that index, to that custom benchmark. And that benchmark similarly has a number of screens. You can see at the bottom things like UNGC violators, controversial weapons, tobacco firearms, but it also tilts into companies that have higher ESG scores. And a higher ESG score might come about if they have fewer workplace fatalities, if they have more diversity policy, diversity training, if they have more clear targets around net zero, things like that. So leaning into those companies. So I think it's a great strategy. It leverages MSCI's thought leadership and their around this, and it's a way of taking a little bit of tracking error, but in a controlled fashion to affect the values that we want to here. So the second thing we wanted to highlight was on the green and social and impact bonds. And so I know there were lots of great questions yesterday. I think Marguerite, you had a couple questions, and Andy was touching on this as well. But as we know, the PB fixed income team manages a little over $800 million, of which about half are in sustainable investments. And those sustainable investments could be green bonds, social, sustainable, or there have been also some pandemic bonds. What's interesting about these bonds is that what defines them as sustainable is the use of proceeds, as we talked about yesterday, not the company itself. And so there could be, Exxon company that issues a green bond to perhaps, build a solar power plant or a green hydrogen power plant. And that bond would be permitted and considered because what we're trying to do is we're trying to invest and finance and help these companies pivot or shift their business towards more green and social things. And so that's the intent. What you'll see later on is it could mean, it means sometimes when you look at data and things like, well, overall, how much carbon is my portfolio producing? It might look worse than it seems because you're getting, well, what are the carbon emissions of Exxon as opposed to just the carbon emissions of that particular green bond? But this is where I think it's important to have this active management and more thoughtful approach to focus on the specific bonds and how the proceeds are being used. So a lot of great work there, and fantastic that almost half of the portfolio is in sustainable investments. I will say on that point, that I don't want to undersell that having half the portfolio in those investments is quite high, and so a testament to how much of a focus this has been and how great it's been from Andy and the team.
Without taking away at all from the very high population we have of green and sustainable bonds, are there investors who take the opposite approach and say, what I'm going to do is buy from the leaders in ESG, regardless of the use of proceeds, in terms of either setting a strategy or measuring their sustainability of their bond portfolio?
You could, that might be done more in like a passive or like a passive approach where you're relying on the third party, in this case, maybe it was MSCI, or if it's bonds, maybe it's JP Morgan or Barclays, to identify who is the leader. So I think that's more often done in that case. Whereas the benefit of the active management is they can focus more on the specific proceeds of the bond.
Yeah, Margaret, to that front, we do have a manager on the endowment side. Their name is Nuveen, and their approach is kind of half and half. It's half of it is ESG leaders, and then half of it is the impact and based on use of proceeds and their fixed income manager. Now, U.S. government treasuries is considered ESG leaders. Just a side note.
And there are managers out there who discreetly and almost in a pioneer-like way, have integrated ESG into their investment process. And one of those is called Breckenridge up in Boston. We visited with them a few times. And so I think that it is a good point to highlight the difference between Andy's strategy, as you mentioned yesterday, not necessarily integrating ESG into each security, although there is some analysis, being done on risks, versus a green and sustainable bond strategy like the one promulgated, and adopted here.
Great. And that's probably a good segue to the next section, unless there are any more questions on that and what we're doing currently.
Yeah, I had a question. I'm wondering if you talked about the word alignment, and I'm kind of wondering about the team's compensation, and I guess we kind of touched on that yesterday, or Frank did, by talking about introducing new benchmarks. So I'm kind of wondering, Dave, correct me, but I think you're incentivized in a different way other than sustainability. And so I'm wondering about that part of the alignment. How do you see the trends there?
Well, I never try to make it about our, incentives or comp. Let's talk about our producing for the members.
Sorry, got it. Yep. Thank you very much. Yes, but
which is what we're concerned about. Yeah,
but the alignment. Yep.
Well, let me take the most practical example to your question, Neil, and I don't have the numbers in front of me, but as a standalone option for participants, we utilize the MSCI ESG Leaders Index strategy. And what we would do would be to track the performance of that index, the ESG leaders, versus the MSCI World Index, right, which is the comparable universe, not oriented toward ESG.
Mm-hmm.
And the performance has been quite a bit better for the ESG leaders than it has been for the regular index.
Yep.
Right. With potential exception of this year, but happy to send you the stats which we track as we endeavor to do faith and finance at the same time, which is to produce excess results and ESG and faith. But that's part of the tracking that we do with all of our managers to see what the difference is between their composite and our screen portfolio. And I can tell you over the last couple of years, trends have reversed so that ESG leaders have done better than the regular index.
Dave, I also want to mention that with respect to engagement, that in our ESG engagement with companies, we've been asking whether or not sustainability goals are tied to executive compensation. So more and more you see that CEOs are being held accountable for meeting the sustainability goals within their particular companies. And I think tying that in really demonstrates a more productive kind of growth in the importance of ESG within the publicly traded companies.
Yeah, maybe I'm just tempted, since Walter's here in particular. I was going to tell you your title, but you got promoted, Walter. But basically, the incentives are such that there are financial incentives, but then there are qualitative, assessments,
Yep,
which are tied to our goals in faith and finance and as pertains to the portfolio. So
okay. Maybe I could ask the question in a different way. I'm wondering if this dedication puts the State Street relationship, which is the largest pool of capital, on the defensive. In other words, to the extent that's passively managed, does that have to go?
yeah, well, I think this is a really great practical question that could be an outcome of what it is that we're doing. We do not currently screen because of concerns about ERISA and DOL findings. We will address whether or not we should pivot perhaps to a screen portfolio and monitor the difference in the performance over time. But Neil, it's a very practical question that could really impact the way in which we implement faith and finance in the portfolio.
Appreciate it. That's an active answer. Thanks.
Yeah, thank you.
Yeah, and then just to follow up on that a little bit more, and then I, in a way to address Frank's question yesterday too, the unscreened index is about 25% of the equity pool. And then in terms of the equity pool that is not screened, the other piece is 8.8% the hedge fund portfolio. And then there's the smaller allocation in some of the mutual funds, commingled trust that is not screened. But then by and large, the index piece is the one that is not screened and then stands out in the equity portfolio.
Thank you, Lan. So excellent feedback, and thank you for following up. Is it possible to keep a track of that, trend? I think as we have our quarterly investment meetings, I think it would be nice to see progress on that front.
Right, and then that I think we will probably hopefully engage the whole investment community to discuss the equity pool, and then our kind of preference in terms of index being screened or not screened, or even using much more aligned indices. Right now, MSCI Paris Aligned has this new index started this year. And there are funds mapping towards that. So there are a number of points that we can discuss collectively, and then certainly wanted to make progresses on that front.
And the only thing I would say along that lines, I'm very supportive of building in additional underwriting or whatever, but part of the goal of the State Street was to be a broad market replication. And so if we start screening stuff out, we want to figure out how to get equivalent economic exposure. For example, if we screened out all the oil companies, then we would have a lot of tracking error and we wouldn't get a broad representation of the economy, which is why we said we wouldn't do that. So we need to keep both masters in mind, that we think perhaps in large cap equity in the US, it's so well understood, maybe there isn't a lot of value to active management, so we hedge our bets, so to speak, by going in with a broad market index. On the other hand, in the hedge fund area, those are highly managed. And so we could consider whether that's a place that there might be a role for enhanced ESG monitoring, or, however you want to discuss it. So I would think we would want to be aware of that as well.
Right, I mean, and then that there are more sustainable ESG managers now in the hedge fund world than before. But still, if you wanted to find a manager have 5-year track record, that's still quite few. And on the index tracking area, I think I don't want to drag this conversation too long. We have the benefit of manage a screened index at endowment. And we actually know quite well what's the tracking error has been, and then it's actually been plus for the last 5 years, except year to date, as Dave mentioned.
Can I just ask, as a general consideration, I think it's also at some point in time, what we're trying to do is a transition. There's no unique pathway, right? So I think, what we're trying to do is come up with best practice and learn from peers that actually are, deploying that best practice. But it's actually to give us the tool and the measurement tools, to be ahead of class, so to speak, what, Dave had referred to. But B, I think there's also at some point in time, we can't have the cake and eat it, right? At some point in time, we'll have to make some choices and some selections as the, as a joint board, because I think that's down the line. So at the moment, we're just trying to make sure that we do have the right data, the right metrics. And again, also acknowledging that we are in, uncharted territory here. I think, we don't have Markovit's portfolio theory, knowledge on the back of ESG kind of stocks, unfortunately. I think, this is where academia is lacking. But this, again, it's just, preparing and paving the way, to make the best decision in alignment with the objectives of the board. So.
I think that's an important point to say that what we're sharing today is where we are now, but it's not where we want to be ultimately, or where we want to go more completely. So this is our beginning, and our future is to be determined.
Well said. And so I think this is all. There were a number of comments there that are a good segue to this next section, which is how much or how do the managers actually integrate environmental, social, and governance factors into their decision-making process? Because as we've all just identified, this is a super complex problem, and screening out certain things is a bit can be a blunt force tool if it's the only tool. If it makes a lot of sense where we're trying to align our values and our mission, but it shouldn't be the only tool to affect change or the only tool to incorporate this into our decision-making process. And as Dave said, in our desire to add value for our participants. And so what our team does is they look at managers and how they integrate ESG, the degree to which they consider ESG. And so for those of you who have been on the committee for a number of years, you may recall Taylor Jordan and John Goldstein, who are the co-founders of an organization called Imprint, which Goldman acquired in 2015, I believe. And Taylor and his team really started this saying, taking a step back and saying, all right, I can look at my managers and I can give them a rating from their investment perspective. We use ABC ratings, but then I can also look at a manager and assess their ESG integration. And it started out that we just did this for a subset of managers, but as this has grown and grown, we now plan on doing this assessment for every manager on our platform. Now with several thousand managers on our platform, that's going to take a while, so we're not done yet, but we're making great progress in going through and assessing every manager.
And Carolyn, fair to say that we pushed you a little bit along the way.
Yes, your managers have gotten priority in being assessed because it's important. So yes, absolutely. But you're right. I mean, we used to only do this for some managers, and you were a key collaborator and input to say, well, we can't just do this for some. We need to do this for all managers. So you can maybe, if you flip ahead to page 17. You can see the different factors that we look at. The one thing I want to flag here is that there is a recognition that there can be a difference between the firm and the strategy itself. So the firm as overall might be very focused on ESG, have a lot of resources there, paying for data, investing in it, supporting it. But it's also important to remember that some strategies lend themselves to considering these factors more than others. So to pick an extreme, if we're investing in a government bond strategy, there are a lot fewer considerations than if we're investing in a corporate bond strategy. Or if we're investing in emerging market debt, where we're investing in bonds from emerging market sovereigns, it's a very different story than if it's like U.S. corporate bonds. So with that, I won't go through all of the ratings. I will say though on page 18, where the output of this is a high, moderate, low rating, and then you'll see at the bottom there are some where the assessment is in progress. And so by high, we mean there's significant emphasis on this. They have dedicated people. It's a very key consideration from the portfolio managers when they're making decisions about what stocks or bonds to invest in. In comparison, if you look at the bottom with low ratings, that would be managers who maybe don't have dedicated resources, or who say, yeah, it's the last thing we look at and it's a tick the box and it's the exercise is done, and aren't really putting a lot of resources on it. Now, as you can imagine, there's a lot in the middle, in the moderate, and then there's some in the high and some in the low. Again, though, the point I want to make is just because a manager we might say has a low ESG rating doesn't necessarily mean it's a bad manager. It just might mean that they're not focusing on it to the same degree as others. And then the final thing I will note to that point, just to make it explicitly clear, there are some asset classes where there are no high ESG managers, that it's only moderate or low, versus others, there are more high, again, just because of the nature of the asset class or the strategy. So this is something we're now doing for all managers, and it's a great consideration, and it's a part of our partnership with the team. When we sit down and review a manager, what are their resources, what are their focus on this, and how do we assess them on this basis? And so we show on the next couple of pages the outcome of those ratings and the summary there.
Caroline?
Yes.
It's Frank. I mean, if you go back on the previous page, have you guys undertaken analysis, just on a X and Y basis? On the one hand, propensity or intensity towards the ESG emphasis, and then return?
It's a great question. We get asked that a lot. We haven't yet, because we don't have the data. So because we're still in the process of rating all of our managers on the high, medium, low ESG basis, we don't have the blanket assessment. And then, once you do, then you would still need several years to of data after that to say, okay, well, what is the correlation between the ESG rating and the investment performance? One could imagine, and one could think, as this goes on and on, there is a high correlation. So those with the high ESG rating could be correlated with higher returns. But I think it also would come down to a question of time period, right? So if we're just looking at a year-to-date time period, we know that a number of managers that have a high ESG rating will have very poor returns because they've been potentially underweight energy, overweight growth. And so we need to look at not just a 6 month, but over what time period, more of a multi-year time period.
Sure, thank you. And also, it goes for the beta of the stock, but so I take that word beta back. Sorry, my other element is what you were referring to, the sector and oil and gas. I think it's fair to say that it's not binary oil and gas exposed to it or not. I think what it is to look at what I would call first and second derivative. To what extent is there intent to decarbonize on the back of their historic footprint? And the second, I think it's the what I would call the second derivative. To what extent is there acceleration towards getting to a net zero kind of footprint in advance of 2050? So if there's a company, and I'm not going to mention one, but I know there are some companies who totally refuse to actually even engage in this kind of reporting, then they should not be part of our portfolio, right? I mean, there's a kind of element. I think it's this is where the more the granular approach, and you hope that what you just have on page 16 at the upper right hand corner, strategy and high ESG emphasis, that this is being undertaken, that this kind of a triage is being considered. So that's my side comment, or maybe try to give some more color to the assessment whether or not to be involved in oil and gas.
No, absolutely. I think it's a great point. And again, maybe it's a good segue to just touch on the next section. But before we go there, you can, I'll use that comment to focus on the particular manager, Lombard Odier. And you can see their rating on page 17, high ESG emphasis, a description of their strategy. They're specifically focused on promoting the transition to a lower carbon economy. That is the strategy. That is what they're trying to do. But what that means is that they could be investing in companies that have, oil and gas companies or other types of companies that today are have very high carbon emissions, might be look dirty on certain traditional metrics. And this is the whole idea about behind saying, just screening something out, might not be the right thing to do. It's we need to engage, we need to promote this activity and support those companies that are trying to do the right thing. And that is specifically what, a key part of the Lombard ODA strategy. And I say that to then flip, if that's okay, to this next section on the report and the analytics.
Could I?
But before I do that, yeah, go ahead, Neil. Yeah.
I'm just kind of wondering on the continuum, the phase in. My last visit to China was November of 1919, so I'm out of date. But I think there were only 3 bond ratings in China. There was AAA, single A, and C. And I met with Moody's, and it was out of control in terms of in other words, nothing had gone bankrupt in China until the recent upheaval and the overlay of the Communist Party. So I'm just kind of wondering, how does the trend toward sustainability and ESG veer away from emerging markets, of which China is 40% content?
Yeah. So
see how that adds up. I'm sorry, I can't figure that out.
Yeah. So maybe a couple of quick thoughts. So one, if you look at page 20, you can see that our emerging markets equity managers are all moderate rating, no high ESG rating there. And so that's to my comments earlier, which is I think consistent with what you're saying, which is, some asset classes, it's more challenging to really say there's a high ESG emphasis. And so, in other words, another way of thinking about it is, one could say that we will only do high ESG strategies. We will, if I'm using extreme language, I say ESG at all costs. And I know that's extreme language, and so I say it that way intentionally. However, what I think the team does really well is saying this is a more complex story, and there are things that are useful in my portfolio that add returns or decrease risk that I want to have in my portfolio for those reasons, even if they don't explicitly meet the high ESG rating. So I think that's how I would answer that part of it. That we agreed. It's not, these managers aren't high. But Dave, I see you unmuted. Go ahead. Anything you'd add?
I mean, and Neil, when Lon and I went over to William Blair in London, they showed us their portfolio system, which incorporated ESG ratings into the ways in which they're scoring. So it informs the analysis. Maybe doesn't quite determine it yet, but it is part of the decision-making process. We also are aware of RBC, Royal Bank of Canada Emerging Market Strategy, which is on the approved list over Goldman Sachs, and they're much more explicit and may avoid certain sectors and economies. But I think from a portfolio management standpoint, where I don't want to get down a rabbit hole, but the factor loading implications of ESG have to be considered, and you will see an analysis of the factor loading in the ways in which Lon in particular has constructed the Sustainable Balance Fund. So it didn't get caught up in the growth craze and sell off, because a lot of ESG managers may avoid certain sectors. But it's, again, I'm
thanks.
It gets too complicated, but but it is a journey and an evolution, and we demand that our current managers explain how it is that they're using ESG in our interviews with them, and the Goldman team does that as well in their separate analysis.
Thanks, Dave.
And to that point, Dave, that you've met with the William Blair team, I would say these ratings are also a point in time, and managers can move up, and we hope lots of managers move up, and hopefully not too many move down, but that's possible as well as the table stakes continue to increase, and we as an industry writ large collectively expect more and more from our managers. So that's one of the other key messages of the day, which is it's a continuously moving, evolving space. So to that point on the analytics and the thoughtfulness around the Sustainable Balance Fund, the next section here, so starting on page 24, we've included a new factor report that we've developed, which we've run on the Sustainable Balanced Fund. And it looks at a number of different data metrics across E, S, and G. It looks at fossil fuel reserves, carbon intensity, so in other words, carbon emissions, workplace fatality, diversity policies, as well as diving even a little bit more on the environmental side, how much revenue of the companies that we invest in, how much revenue is being generated from some renewable or positive environmental strategies. And so this is I think, Frank, to your point, I think you alluded to a comment about this earlier, which is, the first step is you need the data to measure it before you can improve upon anything, or just get your arms around where do things stand. And so we find that this report is really helpful to understand how the portfolio is positioned and what we're doing. It's not intended to be a simple decision-making tool, like look at this, therefore I'm going to fire this manager, hire that manager, but it's an input to the decision. And so if we look at the results, you'll see that the Sustainable Balance Fund does much better versus its benchmark on environmental impact. So it's investing in companies that are focused more on environmental themes than the benchmark. So that's a good thing. The one thing that is interesting is that it does have, as I've mentioned now a couple of times, a markedly higher what's called carbon intensity. So carbon intensity is the carbon emissions from the company divided by the market capitalization of the company. So it's a way to normalize for the fact that some companies are much larger than other companies. And it's driven by these two strategies, the Lombard-Odier strategy and the core fixed income. The core fixed income we've talked about in the past. We invest in a number of green bonds that are issued by energy companies, and just a limitation of the data. The data looks at the carbon emissions of the parent company, not the proceeds of the green bond. So that is understandable. But Lombard-Odier also is, as we've talked about, focuses on companies that are in the process of transitioning. And so that means it has a much higher carbon intensity. And now, if one just looked at that and made decisions off of this, one might say, okay, I don't want to invest in Lombard-Odier because it has a higher carbon intensity. But the team was quite thoughtful about it, because what unfortunately happens is that a lot of ESG managers tend to tilt growth. They just avoid energy altogether. And so they'll invest in technology and healthcare and those types of sectors. And that's done very, very well. However, year to date, they have not done very, very well. They've done quite poorly, in fact. But the team was quite thoughtful about that value growth balance, as well as capturing the different ways in which we can invest in and support climate change and climate transition. And so this report confirms that, but on a go-forward basis can be used to engage with managers to, if we to go back to Lombard-Odier, or if there's another manager that has a much higher carbon intensity, to engage with that manager, say, explain to me how you got comfortable with these companies, why are you positioned this way, how are you considering these things. So that's the summary of the report. I won't go through all the numbers in detail because there's a lot.
Carolyn,
Yeah.
I just wanted to make one comment really in regards to Lombard Odier. I'm not familiar with the manager, but I think that their effort to support companies that are in the process of transitioning ties in really well with George's opening comment, which is that the PB wants to be on the leading edge. So what better way to do this than to support those companies that are trying to change and need capital to do so. So good job, Lombard Odier.
Yeah. Dave, I know we're at time at an hour. Do you want me to take 2 minutes on regulations, the big picture takeaway?
Why don't you just set the tone, because we're clearly going to talk about that in the next section, which you can be a part of. But yeah, let's try to keep a little bit on time. I think the idea here is to give the flavor of the types of analysis that are available, and point the trustees in the direction of where we're headed.
Perfect, absolutely. So on the regulations. The story here is that there are a lot of different regulations evolving. European regulations are further along. There are ERISA rules that have been in place for a period of time, with differing interpretations from different administrations. And then most recently, the SEC has some draft proposals. I think the takeaway is that, one, PB should be a beneficiary of these regulations, as the requirements and transparency increases from asset managers and from companies. So requiring companies to disclose more, requiring managers to use more clear language and terminology, more consistent language and terminology. The second thing is that these three main regulations I referred to, the EU, ERISA, and the SEC, none of them directly apply to PB right now. So PB doesn't distribute in the EU, we're not an ERISA pension plan, and you're not an asset manager. And so while it's important to know what's going on, because it can affect us as beneficiaries, and so we know what's going on in the industry, at this point in time, I think you're in a good spot that you're not required to abide by these changing regulations. So that's the headline. I did it 2 minutes, Dave.
Again, I think more to come there, and I think both on Department of Labor and also relative to the SEC, to the extent that we are packaging our products up and selling them, for example, in our Generations program, I think we want to abide by best practices and be informed by them, and have a clear direction in terms of both how we are investing and how we disclose. So again,
Dave,
yeah.
I have a very quick follow-up question for Caroline. I understand that you've been focusing on the investment managers that are involved with PBUCC. Do you have a wider universe? So, because I presume Goldman is also looking into other investment managers, and would it be possible to also to have a look, if so, to have a look at that distribution? And are there candidates that we really should consider compared to some of the laggards that might be in our portfolio?
Yeah, so we have several thousand managers on our platform, and so can certainly work with you, and we'd be great to engage with you to share, what are the different types of managers on our platform, and how we think about them. I wouldn't describe any manager as a laggard in the portfolio today, but happy to share, for example, maybe some of the broader range of some of the highly rated ESG managers that are on the platform, to give you some more just color and context there. But yeah, happy to follow up with you on that.
Thank you.
That would be great. And I would tilt that as you're looking at it to the places where they're bigger off-index bets. For example, I would focus on something like we have Select that has a highly concentrated portfolio. That's where selection could make a huge difference in terms of carbon intensity or human rights or whatever. And then I'm very interested in what you find out when you get to the hedge funds and evaluating them. But any information there will be helpful to us going forward for sure. Thank you.